Hello, investors. I'm happy to be talking to you again. Mali Investment Talks is our favorite show talking about financial independence. I would like to continue appreciating all of you, those of you who get back to me, give me feedback. Please continue, ask me the questions, give me the calls, and let's together make sure that sometime soon we should all be financially independent. Please continue to make sure that you subscribe to the channel, spread, share the videos with your friends and ask them to subscribe to the channel. And also, if you like the show, make sure you give me the likes. If you have any issues, please let me know so that we can address them. Today, we would like to continue, I would like to continue addressing questions raised from you or by a number of you, my dear followers. I will start with Celine once again. Celine, you were asking me with respect to treasury bills. Are there other fees or other charges? Celine, it depends on how you are accessing these treasury bills. If you're living in Kenya, for example, if you go direct to the central bank and access these treasury bills through the central bank, you basically not going to pay anything. If, on the other hand, you access them maybe through your bank, and like in Uganda, we basically go through the bank, and the bank does the rest. Some banks will charge you a small fee for that service. Others will not. So it's on a case-by-case basis. If you're accessing treasury bills, in some cases, you might access treasury bills through brokers. In many of our countries, there are brokers. They will charge you a small fee. Okay, so it's on a case-by-case basis. But even if there are fees, they tend to be very, very small. All right? Celine, you also asked if companies reinvest dividends. So I think you are referring to a video where I said companies are not obliged to pay dividends. Okay? Sometimes they can decide to reinvest the money that they should have paid as dividends into maybe capital developments, capital growth, or whatever other investments in the company. All right? So your question is, if they reinvest the money which should have been paid in dividends, who benefits? Is it for the investors' benefits? Well, there is no guarantee about that at all, Celine. Obviously, you would hope that the reinvestment results in growth, okay? Growth in the company's balance sheet, growth in the company's assets, and ultimately growth in revenues and therefore income. And that can result in growth in the share value, the share price could go up, but also it could mean you get higher dividends next time. But that is not a guarantee, all right? It is, in the end, the discretion of the board of directors to declare or not to declare a dividend, all right? Mukaire John Bosco, you ask, what happens if a bond maturity reaches and I decide to leave it there? Do I still earn? The answer is no. In fact, the answer, Mukaire, is that you don't even have that option. Once your bond matures, then automatically the amount, the face value, is wired or sent to your account, right? And it will stay there in your account. It's up to you if you want to reinvest it, it's up to you. If you don't reinvest it, well, then it just stays there. With one exception. So lately you might have been hearing talk of bond switching or switching of bond maturities. So the government can offer in certain instances or sometimes to switch a bond which is otherwise maturing with a longer, another bond with a longer maturity. That means maturing at a later date. So what that would mean is that instead of you being paid the face value of your bond when it matures, suppose it was supposed to mature at the end of this year. So instead of you receiving that money at the end of this year, you will continue receiving coupons, and the date, the maturity date, the date for payment of your face value will now be deferred into the future. Okay? But that is if or when a government makes that offer. If they do, of course, they will publicize that offer in the press, and then you can express your interest. But if it doesn't, the basic default position is that upon maturity, your money is automatically sent to your account, to your bank account, and it stays there. So you will not be getting any further coupons or whatever after maturity. All right. Ayuma, you ask, what is the disadvantage of buying shares when the company already closed books? So what Ayuma means is when a company closes the register of shareholders who are entitled to receive a dividend, right? What is the disadvantage of buying shares after that register has closed? The basic disadvantage, Ayuma, is that you will not receive a dividend. In other words, the shares that you buy after that date, after the closure of that register, will not attract a dividend. If you had shares before that register closed, those shares will attract a dividend. But after that date, whatever shares you buy will not attract a dividend. On the positive side, though, because those shares bought after that date will not attract a dividend, their price is likely to come down. So you will buy the shares cheaper than if you had bought them when the register was still open. So in the industry language, we say if you buy shares after the closure of the register, we say you're buying them ex-dividend. If you buy shares when the register is still on, in other words, dividends have been declared and the register is still on, we say you buy them cum or cum dividend, C-U-M dividend. All right? But if you buy after, you basically do not, those shares will not get a dividend. Anne, you're asking me to clarify on the long-term investment. To be precise, an infrastructure bond. For instance, the June 2022 has already paid the first coupon of, let's say, 5,670 shillings. The question is, will this amount remain constant till maturity date? So what Anne is saying, Anne is alluding to something I talked about earlier in an earlier video, which is that sometimes when you buy a bond, some coupons will have been paid earlier already, and at the time you're buying, maybe some coupons will have accrued. But the basic point for Anne is this: the coupon is fixed and constant. So depending on how much money you have spent, all right, and therefore depending on what face value, how much face value you have bought, there is a certain fixed amount payable as a coupon. So it could be 10%, it could be 11%, it could be 12%, or whatever it is. Okay? That does not change over time. So every 6 months, you will earn that fixed amount until the bond matures. So if that is the 5,670 shillings that you're referring to, that will not change. You will keep receiving that 5,670 shillings, even if you've just bought that, that bond maybe from the secondary market. That is the coupon you will keep getting. So please keep the questions coming, keep the comments coming, keep the compliments coming, keep those likes coming, and I will be very, very happy to receive them. But also, do not forget to subscribe. Subscribe and ask your friends to subscribe to the channel. Thank you very much for your questions. I will be talking to you again in a subsequent video.